Sorry, I had a little technical difficulties there. Ran out of space on the camera, or on the little card that's in the camera. Anyway, accounting methods. And so here they talk about the comparison of financial and tax accounting. Just remember that financial accounting is conservative, and here GAAP is slow to recognize income but quick to recognize losses or expenses, and not so much for tax accounting. It's kind of the other way around in some areas. In financial accounting, the objective is to avoid misleading investors and creditors. So accelerate expenses and put off recognizing revenue as long as you can. As long as you still have to meet all the requirements, though. If it's earned in a year, you still have to recognize it in that year, right? With tax accounting, much less conservative, you're quick to recognize income, but likely to defer deductions. And the objective here is to maximize tax revenues. So where in GAAP you might defer income, such as with prepaid items that you're receiving, you have a customer who prepays you, you wouldn't recognize that in financial income, but you would recognize that in tax accounting income, or income for tax accounting purposes. So we'll look at that here in a minute. And so there are three permissible overall methods. The first is the cash method, and most sole proprietors work on a cash method. And so under the cash method, you recognize revenue when you actually or constructively receive cash. And so it doesn't have anything to do when you provide the goods or provide the service. It's all about when you either actually or constructively receive cash. That triggers income, taxable income. As far as expenses are concerned, cash method taxpayers recognize an expense when it's paid, not when they get the bill, not when it's owed. Accrual, it's just like with that's the next permissible method. Excuse me. And that's just like GAAP, pretty much. But there are two basic differences between GAAP accrual and tax accrual, and we'll talk about those here. And then there's a hybrid method. That's usually where you've got like the sale of inventory. You would recognize revenues and expenses related to inventory on an accrual method. Everything else would be a cash method. So just like with the tax year, the accounting methods are adopted with the first tax return, and again, if you change, you've got to get approval from the IRS prior to changing. Most large corporations must use accrual method. So cash method, income recognized when actually or constructively received, expenses recognized when paid. The pros and cons. It's flexible. It's simple and relatively inexpensive. But it's not GAAP, and as such, there's poor matching of income and expenses. Note that cash method is not available, and we're talking about tax, for tax purposes. C Corps can't report on a cash basis. They have to use accrual basis. Accrual income. Income is recognized when earned or received. You get into this all events test, which in general just says that you recognize income when all the events have occurred which fix the right to receive such income, and then the amount must be able to be determined with some reasonable accuracy. Well, that kind of sounds like what we talk about in financial accounting as to when we recognize income, right? And so they give you three choices. It's got to be the earlier one of these three dates. The date you complete the service or sale, the date that payment is due, or the date payment is received. Well, how is that different from accrual accounting? Note, if you receive payment, if you receive a prepayment before you've completed a service or provided a good, you're more than likely going to have to recognize that income even though you've only received a prepayment. So that is very different than GAAP accounting. I don't know what they're doing here. Ben provides consulting services and bills Ace for $12,000. Ace disputes the amount, claiming that $8,000 is the proper amount. How much income should Ben recognize under the accrual method this year? Well, if there's a dispute, I would suppose that Ben doesn't have a legal right to all of it yet. So I think the undisputed amount would be the amount that's would be recognized. Whoa, what happened? Well, $8,000. Not sure what happened to the numbers. All right, so here it talks in more depth about prepaid income. Advance payment for services. You're allowed to defer recognition for 1 year unless income is earned or recognized for financial purposes. This is not applicable to payments related to rent or interest income. But note, if you receive a deposit on a rental, you don't have to recognize the deposit, but you would recognize prepayments for rent and things like that. As far as advance payments of goods, you can elect one of two methods. You can elect the full inclusion method, which would, in that case, you would recognize prepayments as income, or you can use the deferral method. And what you would do there is you would include it in the period earned for tax or financial purposes. So we have an example here. Ben provides a service, dance lessons. On September 30th of this year, he received $2,400 full payment for a 2-year service contract. What amount of income must have been recognized? Number one, if he is on the cash method. Well, if he's on the cash method and he receives the payment up front, he's going to have to recognize $2,400 in that year ending. It doesn't say what he is, but if he's a sole proprietor, he's going to do cash method. So in that case, he's going to recognize in that year $2,400 regardless of when the service is provided. Accrual method, he can delay that just like you could do with accrual accounting in under GAAP. So he can defer some of that $2,400 until it's earned. So $2,400 if he uses the cash method. If he uses the accrual method, then he can elect to defer advances until he provides the service for one more year. So notice, he got payment on September 30th, so I'm not sure when he starts these, but assuming it's 10/1 is when he starts these services, he would recognize 3 months worth of income in that year. Then he'd recognize the rest of the income in that next year, even though that the services are actually going to go beyond that next year. Okay, so you can only defer it for one more year past the payment. Whoa. So that's what we have here. $300 in that first year for those 3 months, and then $2,100 for the next year. All right, so inventories must be accounted for under the accrual method if sales of goods constitutes a material income producing factor. And it usually does. Unless you've got just really an inconsequential amount of inventory, it's going to constitute a material income producing factor. And so purchases are accrued on when an accounts payable is created, and sales are going to be accrued when a receivables is created. Note that cash method taxpayers may use cash method for other non-inventory accounts. That is what we call the hybrid method. So if you're a sole proprietor and you have inventory, you're going to have to, you're required to account for that inventory if it's a material income producing factor, which for most inventory carriers it does. Going to have to do that based upon the accrual method. Then everything else could be cash method, or so that would be a total hybrid. Not going to talk about unicap. Inventory cost flow assumptions. Talk a little bit about that. So you get 3 methods that you can use. Notice what you can't use. What is different here than financial accounting? If you recall, you have 4 inventory cost flow assumptions, do you not, under financial accounting? Here, you don't have the option of weighted average. You have first in, first out, FIFO, last in, first out. It says last out. It's supposed to be last in, first out. LIFO, and then specific identification. If you are going to use LIFO for tax purposes, you have to use the same method for financial accounting purposes. That is what they call the book tax conformity requirement. And of course, LIFO generates the lowest taxable income in a time of inflation, just like it does with financial accounting. So that's all we'll say on that, because the rest of it is the techniques are just like what you use in financial accounting. The only little added twist is that if you use LIFO, you got to use LIFO for both financial and tax purposes. Okay, let's see what else we want to talk about. Just a couple of things. Accruing business expenses. And again, this applies to accrual method businesses. You have to meet two tests. You have to meet an all events test for the liability in order to incur the liability, to expense it on your taxes. And you also have to meet the economic performance test with respect to the liability. Now, the all events test is similar to the all events test for recognizing income, and the additional economic performance requirement makes the deduction recognition rules more stringent than income recognition rules. The deduction rules generally preclude businesses from deducting estimated expenses or reserves. And so note down here in the economic performance test says that the specific requirements for economic performance test differ based on whether the liability arose from, and they list, receiving goods or services from another party, use of property, providing goods or services to another party, and certain activities creating payment liabilities. And so just a couple of things to note here: when you're renting or leasing property from another party, the economic performance accrues over the rental or lease period. And so the business is allowed to deduct the rental expense over the life of the lease. As far as payment liabilities, economic performance occurs when business actually pays the liability. Thus, the accrual method businesses incurring payment liabilities are what? What does that look like when under the economic performance test, they can only accrue a liability when they pay it? Well, that looks a lot like the cash method. So that's kind of weird, and you might have to wrap your brain around that for a while. Look at Exhibit 9-3 for categories of payment liabilities. So note here, accounting methods are generally adopted by use. A permissible method is adopted by using and reporting the method for 1 year. Note that you can adopt an impermissible method as well, such as when, let's say, a C Corp adopts the cash method. Well, that's an impermissible method for a C Corp to have a cash method, but if they use it for 2 years, they have adopted that method. Okay? So, another thing to think about. Either way, if you've adopted a method, whether it's permissible or impermissible, and you either need to change because it's impermissible, and you go, oh, my bad, I need to change to a permissible method. If you've adopted this method by using it for at least 2 years, you've got to get the IRS's permission to change to a new permissible method. Same for going from permissible method to another permissible method. You've got to get the IRS's approval. One more thing I want to talk about, and there's really no spot for it, but I'll talk about it anyway. Bad debt expense. We'll talk about that a little bit more in taxation of business entities, but essentially, the only time you can have a bad debt expense, meaning you had a receivable, you provided a good or service, you had a receivable, and your customer was supposed to pay you, but they stiffed you. That's where this incurrence of a bad debt expense is going to happen. And so the only time it's permissible for a business to deduct a bad debt expense is when they are an accrual method, under an accrual method of accounting. Why? Well, it's because under the accrual method, they actually booked the receivable into their accounting records for both tax and financial purposes, as a matter of fact. If you're a cash method taxpayer business, you never booked the receivable because, if you recall, you don't recognize income for tax purposes until you actually receive payment. So because you'd never booked the receivable, you're not allowed ever to deduct a bad debt expense, even though you've provided a good for services and have been stiffed. So, kind of a mess. Anyway, that's it for this chapter. And so, anyway, we'll go on, I believe, to Chapter 10, Property Acquisition and Cost Recovery, next.